What is up, party people? On the internet, we're on Facebook, we're on Twitter, the YouTube action. All right, let me see here. I'm still learning with the StreamYards. It's going pretty good. Got the buttons worked out, so that's fun. Well, it's not working perfectly. It is what it is. Inflation data tomorrow is going to be massive. We're going to talk about that today. I'm going to talk about some of the deflationary activities, the Fed. We're going to look at the economic calendar today for a second here, just to kind of see what's going on. Also, this article, I'm going to take a real deep dive with you on this. All right. 10 U.S. real estate markets that are cooling the fastest. San Diego on the list. Is there anything we should be worried about here? Is there something concerning about this? And we'll take a very close look at this. So I want to get to that. We might look at some charts. We might look, still right now, financial markets it looks ugly. The charts are ugly. We may get to that. We'll see. Also, do some comments later. If you want to comment live, we are live here on multiple platforms. Drop a comment, and we'll do some questions or comments later on as well, and have some fun today. Why not? Let's do it. It's Tuesday, July 12th. Let's get to it. Okay, so here's the deal. Tomorrow, actually, let's look at the economic calendar. Tomorrow is Wednesday. And what we've got is we've got consumer price index month over month, consumer price index excluding food and energy month over month, and then we've got the consumer price index overall year over year. So that's all coming out first thing tomorrow. First thing, 8:30 a.m. Eastern time, 5:30 Pacific. Kaboom. We also have consumer price index year over year for food and energy. So both of those month over month and year over year numbers are going to be coming out. So we have to take a look at that. There's also a 30-year bond auction. Today's bond auction, no bueno, not looking good, which is crazy to me based on where rates are. But it just shows you right now that there's a lot of money on the sidelines waiting to see what happens. A lot of money on the sidelines just kind of going, hey, is it time? Is it time? And that's big money that we're talking about when we look at those bond auctions. So this data that's coming in tomorrow is going to be absolutely crucial. Now, here's a little bit of insight on just what may take place and what the market may be pricing in, okay? Because right here, at this particular point, we're expecting that tomorrow's number will be the biggest one. So we're expecting the year over year to be 8.8%. And at 8.8%, that is definitely the highest one we've seen. We're almost at 9% there. However, remember, this is June data. Since then, there's been quite a bit of deflation. And so, just this month, the past couple of weeks, there's been quite a bit of deflation in gas prices and amongst other things. So what economists are saying is that, hey, that this number that we're seeing could be the peak. That could be it, which means if it's true, sell the rumor, buy the news is kind of what the play would be. And that lines up with the market action today. So what I mean by that is you would sell the rumor that inflation is going to be peaking or inflation is bad, and then you would buy the news when you finally see the worst number, what looks like the worst number. That's the bull trap, and that's what people might buy. So it lines up with the action today too, which was negative pretty much across the board on all asset classes. I think even gold, oil, everything was down today. And if we were going to see an update tomorrow, usually the day before those data releases, whatever happens that day, the opposite is taking place the next day. Not always, but usually. So that's kind of what you'd want to see. Crypto too, also down today. Just not pretty. Nothing looking good. All these charts are terrible. That's just a reality. So we'll see. But if it's true, core inflation here also, excluding gasoline and food, is expected to go from 6% to 5.7%. So that would be the third month in a row of slowing. And, that those types of things could add up to, hey, we don't have massive inflation like we used to. Maybe that causes the Fed not to ease or not to raise, to tighten as much. We'll see. But it could be, tomorrow could be a catalyst. It could be either way. Remember, markets can always move either direction. It's totally possible. But if we are seeing the peak, because now we're seeing some deflation, you're seeing things not cost as much. You're seeing people not willing to pay as much for cars, pay as much for houses, pay as much for anything. If that's true, and this really is the peak, then that could be the signal that's needed for things to move forward and continue higher. we'll see. It's always hard to say. Kathy Wood did say, oh my goodness, you jerks. So apparently now they won't even let you look at the headlines on the CNBC Pro. But basically, Kathy Wood said in an interview that there's deflationary forces and pressures that could cause the Fed to change course, which is exactly what I've been saying, and exactly what we've been talking about here. That the Fed is really who we have to pay attention to because they're the one who moves the market. They are. I hate it. It shouldn't be that way, but that's the way it is. So we can't have it the way we like it. This isn't Burger King. We have to just pay attention to the market, see what's going on, and note who are the market movers. The biggest market mover of all is by far the Fed. So what they're doing makes the biggest dent in what's happening. I will share with you, we'll go into what happened with mortgage bonds today. We lost 25 basis points, and the charts don't look great there, but it's still hanging on. So we'll go through that as well today. Forgot to mention that earlier. All right, so let's look at this article. I saw some people sharing this, on social media and stuff. And, initially I was like, oh, wow. San Diego's on the list. I don't know why it loops those automatically. Sorry about that. San Diego's on the list. The top 10 quickest cooling markets. Is there validity to this? Is there anything to this? Let's take a look. So let's dive into what we're actually talking about here. What are we actually talking about? Let's get down the list. Okay. 10 fastest cooling U.S. housing markets. How are we determining this? Well, we're using Redfin. Okay, I trust Redfin's data. Cool with that. And we're looking at, there it is, the median sale price. Median sale price. Why is this important when you're looking at data? Well, let's see. Oh, I forgot to open this up. Shoot, I had something else working here. All right. So if you are looking at a median, you're looking at the numbers that you have, whatever they are. They could be lots of different things. 10, 12. The median is the one in the middle. Okay. It's just the one in the middle. It has nothing to do with the average. People hear the word median and they think average. Average is not median. Median is just the middle. Average, when we say average in mathematical terms, we're talking about the mean. Okay. So if they had said mean, that would mean a lot more to me than by saying median. Let me explain to you why. Look at all of the top 10 fastest cooling housing markets. Look at them. What's the lowest price point market? High 500s. Stockton, Boise, which is the one that everybody has their eyes on. Denver in the low 600s. Tacoma, Washington in the high 500s. Sacramento's in the 600s. This is a median. But most of these are millions and plus. Why does that matter? Well, when interest rates do go up, when a market does soften, typically the first place to feel that is at the higher price points. That's usually where you'll see, like, for example, entry-level homes, the cheapest 3-bedroom, 2-bath detached house you can buy. That home is going to be desirable for so many more people that even if demand shrinks, there should be enough people there to want to purchase it. When you have a $4 million house or a $2 million house, demand shrinks. Maybe there was 3 or 4 buyers for that house before. Maybe now there's 0. Maybe there's just 1, and they're the one who wants to put a low ball offer in. So when demand shrinks, usually the lower price points stay stronger, and the higher price points tend to come in. So when we're doing a median calculation, the median will drop if the higher numbers go away. So for example, this isn't a very good example because it's very random, but let me just add 2 more numbers on here randomly. So now the median on here is still 7, but if I take out the 16 and the 12, so these higher price sales, I take those out, now the median drops down, right? So just with the same scenario, but none of this had changed. None of this part of the market had changed. It was only this part of the market that changed, but it's affecting the median. Does that make sense? That's why I never look at the median. We never talk about the median. The median doesn't make any difference whatsoever. Actually, maybe you can see this better if I do it differently. Like this better. We never talk about the median because the median is a useless piece of information. Literally, it is a useless piece of information. It does nothing, helps nothing, explains nothing, points to nothing. So that's why this is really just gibberish. Frankly, this is pointless, makes no sense. Let's talk about mean. Why not put the average prices? Those are still going to be affected heavily by the higher end homes, but not so much. I mean, my goodness. And we're talking about median. So San Diego made the list here, number 8 in the top 10 fastest cooling housing markets with $875,000 median, which, I don't know where the median was because I never look at it. As who cares what the median price is? But here's how you can also measure that. So before I looked at the top 10 slowest cooling U.S. housing markets, which is what's coming up next, I made a prediction. I wish I would have done it live with you, but I didn't. So you have to trust me that these were going to be lower price point areas. Let's take a look. 10 slowest cooling U.S. housing markets. Look at them. Okay. We've got 1 out of 10 in the 500s, and it's in Connecticut. I don't know. Yeah, that's an expensive market in the first place. But most of these are 200s, 200s, 300s, 200s. You got one here in the 400s in New Jersey. 200s, 200s, 300s, 300s. So if you were writing this report, if you were writing this article, you checked yourself at all. In other words, you looked at it and you were like, okay, does this make sense? Like, am I actually reporting anything useful here? You would have been able to see that, these markets are all lower price point markets. These markets are all higher price point markets. Is there something wrong with my approach in the data that I'm using to try to create a comparison here? And you'll see that median is definitely the wrong way to go. You should never use median ever for anything. So this data is literally worthless, completely worthless, does nothing, shows nothing, proves nothing. But other than in these markets, these higher price point markets, the higher end homes may be selling less frequently. That could literally be all it means. It could actually mean something, or it could not. It could mean something for Sacramento, but mean nothing for San Jose. It's not something we can use to look at a market as a whole. So I had to explain this because I saw a lot of people posting this today, especially since San Diego made the list. And while you don't want to see that, if you're a San Diego homeowner, like, hey, this is a really fast cooling market. Like I told the story yesterday, we got our offer completely declined. We were $20,000 above list price on this property. Found out today that property went into escrow for $10,000 above what we had offered. So while we thought that was a seller was being greedy and stupid, the seller actually was right. The seller made out. So while there may not be the frenzy that we once had, this is just not a good metric. So let's just bury that, if we will. And by the way, we're live. You can write comments in. I will get to comments in a bit. You can shout. You can ask questions. We'll go through all of it. You can share this with your friends. For people who don't know, this is, I'm not a YouTuber. That's why you didn't watch any commercials. In order to see this, I do loans. If you want to quote, if you're looking to buy, looking to refi, give me a shout. Make sure we get you a great rate. No lender fees, no BS. We will shoot you straight. Oh, I got to share this with you guys. This is so cool. All right, check this out. If you haven't seen this yet, be prepared for your mind to be blown. So this James Webb Space Telescope is now deep in the depths of the universe. It's like 1 million miles from here or something like that. And it is taking the most insane photos of space. This isn't the best place to do it. I would recommend actually following it on like Twitter. They have an account for it. Oh my goodness, it is unbelievably crazy. So insane. The pictures that it's getting of the universe, mind-boggling. All right, let's take a look here at mortgage bonds. So, we follow mortgage bonds closely. We didn't want to see the breakdown here of this. We lost this trend line, which is unfortunate. We had a nice channel going there. Not like this couldn't be one too. This is always possible. I hate redrawing lines though. It's like a bad sign, like you're trying to hope for something. But we are still kind of, we're channeling higher off of this low. There's a multi-year low for mortgage bonds. Remember, we want to see mortgage bond prices going higher because that means rates are going lower. All right. So that's what we're rooting for. We want these prices to go up, not down, coming off of a multi-year low here. Not a whole lot of bounce. Although I'm okay with, I'm okay with this being the day before inflation report. We don't know what's going to happen here, but inflation is going to come in hot. Remember, the Fed looks backwards, not forwards. The Fed is always looking backwards. They are terrible. They don't look forwards. They look backwards and they make decisions about what happens in the future based on the past. That's what they do. They're going to look at this. They're going to see a hot inflation report. My guess is they're going to ease 50 to 75 basis points this month. That is actually good for bonds. Remember, the last time the Fed raised rates, mortgage rates dropped 0.25%. I know that's hard to understand, but basically what we're doing right now is we're looking for what's inflationary, what's deflationary. Things that are inflationary are bad for mortgage rates. They're bad for the economy. They're bad for the dollars that you have in your bank account. Things that are deflationary are now all of a sudden good. So we're back to that bad is good is bad thing, which is weird. But when the Fed is involved, that's how it works. When the Fed is involved, bad is all of a sudden good and good is bad. So we want to see deflation. So like if house prices coming in a little bit, that's good. Consumer good prices coming in, that's good. Car prices coming down a little bit, that's good. Stock prices coming down a little bit, valuations coming down a little bit. Microsoft is laying off people, the first little round of layoffs that they're doing. Those things are good. I'm, up against essentially people, especially all over YouTube. Listen, if you're bearish on the market, that's fine. Be a bear, but have your reasons, know what your position is, know why you believe that. Because as of right now, we would need something pretty significant to be a follow through for what's already on the table for the market to head much lower than it is now. It doesn't mean that it can't happen. It just means that we don't have that information yet. So if you're banking on that, you're betting on something else happening, not just what we already have, but something else, something new coming into the picture. And the Fed not being willing or not being able to step in and do something about it. That's kind of what you're betting on. I think that's a very unlikely situation to bet on. I wouldn't put my money on that. That's for sure. I am still short the NASDAQ though. Full disclosure, I have a short on the NASDAQ that we've had. They called it almost perfectly. Of course, you look back at those and go, man, I wish I would have gone bigger on it, but it is what it is. Listen, it's just a hedge for me against the rest of my portfolio. And, I haven't closed it yet. So, truth serum, right? I'm not 100% bullish on stocks. That's for sure. And stocks are going to kind of roll with the Fed. The Fed is still tightening. That's not good for stocks. So I haven't closed my position yet. But when the Fed changes its mind, that's when you can see V-shaped stuff. That's when you can see parabolic recoveries. That's when you can see things move really, really fast. And most likely, the market will move that quickly in that direction before us peons have any idea that it's even in the works. It'll just happen. And we'll rejoice, but we might miss it if we're not paying really close attention. This is one of those times where I think it makes a lot of sense to go ahead and pay very close attention to what's going on, especially first thing tomorrow morning. So that's 5:30 a.m. Pacific for all my California peeps. 5:30 a.m. we're getting the inflation data. And that's going to, now the market is probably already made its mind up which direction it's moving tomorrow. And my guess is that we're going to see it go higher. Of course, it could be wrong, but usually the day before we're going the opposite. It's sort of like a little setup. It's a little way to just kind of get things going into the direction that the big boys can make the most money with. And from what I'm personally seeing in the marketplace, I'm seeing a lot of the people who, were involved in the market a lot. They're sort of out. There's a lot of people who are on the sidelines coming back in. So just in the past couple of days, from my perspective, seeing buyers who, were like, I don't want to deal with the frenzy. They're coming back to the table. They're interested. They're getting pre-approved. They're looking at properties. And we're still seeing, things move relatively well. Now, if we really wanted to get a feel for the market, there's like two people to talk to, right? Talk to investors. So like flippers. This is a really bad time to be a flipper right now because flippers really count on being able to sell their homes, their inventory quickly. They need to move the money fast. That's just a part of the model. They renovate these homes. They hold them for as short a period of time as possible. And they really need to sell them fast once they put them on the market. And this isn't a market that's moving that fast anymore. It's not moving that quickly. Buyers are taking their time. They're going back for second showings. They're not removing all their contingencies right out the gates. They're doing more due diligence. We talked yesterday about the increase in cancellations. That's because inspections are actually being done. Things like that. So it's not a super fast market. So not ideal for investors. Investors will probably give you a pretty negative sentiment right now. Another good group of people to talk to, which I have been lately, is realtors who cold call expired listings to get a feel for where those are at. How are people whose homes have come off the market? What are they doing? Are they just out of the market? Were they really disappointed with what happened? Or they didn't get the money they wanted? So what now? Turning it into a rental? Just going to stay there? Getting that kind of information. So that's been really helpful and interesting. It just doesn't feel like I have so many people who are telling me, like yelling at me online, the market's going to crash. You're misleading everyone. Blah, 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 blah. Well, here's the thing. Show me a crash. I'm open. Really, anything's possible, right? I'm always going to say that. I'm open to it. Show me why. Tell me why. Tell me why. Give me a reason. I'm looking for it. Tell me why. Give me a good reason. Not just I can feel it. Not just, there's this cascade of fear that's going to roll down the hill. Don't prognosticate something. Tell me what's actually going on. Tell me what's happened, what you have, not a feeling. Tell me what's happened. And, it's fine to be bearish. There's nothing wrong with being bearish, but just have a good reason, because that's what I'm up against, is people who are like yelling at me for the fact that there's going to be a crash. When in history have people been yelling about a crash and then a crash happened? Do you think that like in 1928, people were like, the stock market's going to crash, or like the tulip craze, that they were like, the tulip market's going to crash? No, that's not the nature of how crashes work. Crashes work or happen because they catch everyone off guard. I remember watching it was like a PBS type thing. It was a professor from, I think it was UCSD or USD, who was doing this thing. It was on like public television in 2006. We're watching regular television, 2006. I'm in the mortgage industry. I'm watching this thing, and this guy's talking about the housing bubble and how it was dangerous, how the loose credit system that was going on Wall Street was dangerous. And no one listened to this man. But there weren't people, online, everyone, like a huge contingent of people going, the market's going to crash. That didn't happen. That didn't happen. And when there is, and that's why I've been trying to explain, like when there is a huge contingent of people who are telling you the market is going to do something, they're pretty much preventing the market from doing that. And it's a more complex explanation to explain why, but essentially you need people to be caught off guard. You need people to get rug pulled. You need people to fire sale stuff and to have a reason to do it, and to want to do it, and to really to need to do it in order for a crash to take place. I don't see that we have that. Now, I do think where probably some of the best opportunities will be, it's definitely not on this list. Pay no attention to this. This is terrible. This is just not good information. And because of where it's posted, because it's from a reputable site, and by the way, it also got shared, what they call the like viral elements. It got like picked up by different news outlets and stuff like that, and sort of rebranded in multiple ways. I mean, is anyone paying attention to what the data actually is? This is why you've got to just read the information to see it. You can't trust anyone. But is there anyone, do we have a situation where it's ever happened where everyone thinks the market's going to crash and it does? I don't think we have. But I do think that the markets to pay attention to, not these, are the second home markets. Boise was listed on here as one. One's closest to us here in Southern California, Palm Springs, is definitely one of them. Big Bear is another one. Look out. Big Bear is a market I've been watching for a long time. Well, you know what? We'll probably do a home search for Big Bear. And I see your comments, by the way, and I will get to those here in just a bit. If you want to say what's up, or if you have a question, or if you have a comment, go ahead and drop it in there. We're live on multiple platforms, so I'll get to those in just a second. But Big Bear is a market I've been watching for quite some time. It fluctuates significantly because there isn't as much liquidity. There isn't as much inventory up there. And when inventory hits the market, sellers will get pretty desperate. And so keep an eye on the inventory. If you're looking in that market or you wanted to own something up there, keep an eye on it the next 6 months. Watch and see if the inventory really creeps up. If the Airbnbs aren't doing well, because a lot of those are Airbnbs. If the Airbnbs aren't doing well for some reason, you're going to see a lot more of those hit the market. And you could see like a market like that. You could see that market crash, if you will, where prices could go down by 25 or 30 or 40% pretty fast. It's a small market. It's a very small market. And it's a seasonal type market. Palm Springs is not as seasonal, but it has some of those same type of elements where it's more of a destination. It's a second home type market. There's a lot of Airbnbs over there as well. So those are two markets where you could really start to see some opportunities here in the next 4 to 6 months where there could be a fire sale or two. It doesn't mean the whole market will be on sale. Though it doesn't mean the whole market will be fire sold. But if you have, one or two really motivated sellers in those markets when there's a bunch of inventory, a bunch of competition, you might, if you catch the right one, you could really get a good deal. And so those things are coming up. Those things are possibilities, I believe, here in the next 4 to 6 months. I'm personally keeping my eye on. So maybe we'll do that on one of these videos. We'll go through some of the stuff I'm looking at. I'll show you some of those things I think are interesting and potentially worth getting eyeballs on. But everything is going to sort of hinge tomorrow on what action takes place based on this inflation data and where we go from there. So let's go ahead here and take a quick look. What's up, Sarah? You could say hi anytime. Great to hear from you. Hope all is well. You're awesome. Tony C is in the house. Yes, sir. I see you're letting your hair grow out too. Is that what I saw? I think I saw that. Market here is ruthless with escrow in Florida. Yeah. Florida is a totally different market. I have some experience there for sure. But it's it's definitely a different market. What's up, Nathan? Hope you're enjoying Alaska, my man. That is awesome. Good to see you out there. My opinion, 1929. What do you think is going to happen to the market? How high will inflation go? We've probably seen the worst of it. I mean, that's my prediction. My prediction is we've seen the worst of it. Because think about it. Think about what we had. Okay, this is a great question. A simple question, but a great one. Because, all right, well, we had supply chain issues, right? We had COVID, which caused a lot of those problems with supply chain issues. It sort of tumbled down the hill, right? We had the Fed easing in the beginning of that. Remember, when we first hit inflation, when I was first on this channel saying we have hyperinflation, it's here, the Fed is stupid, they're not going to catch it, it's going to take them forever to get to it. We were right about that. They were easing at the time. So in the beginning stages of the inflation, the Fed was easing, aka making it worse. We had a bunch of supply chain issues. There was crazy lack of inventory on everything. There was no houses for sale. There was no cars for sale. All that stuff was going on. And then we had problems getting things to the shelves. Remember the bare shelves hashtags and all that stuff. We don't have that really anymore. That stuff is kind of behind us. There's still a few supply chain issues out there that are still getting solved, and port issues and just big macro transportation issues and stuff like that. And then, we have the Fed now actually tightening. So a lot of that stuff that had sort of gotten the momentum of inflation going are not there anymore. And in fact, the Fed has reversed, and now they're not helping it. They're actually trying to hedge against it. So I think that we probably are seeing the worst of it. This is probably the end. We may have already seen. I think inflation probably has already peaked. Great question. What's up, Michael? A lot of people traveling. Yeah, true. Yeah, this is a time of year where, just historically speaking, and people who are in like more seasonal type locations, like back home for me in Missouri, they will say like, what do you mean the market gets slow in June and July? That's when our market is the hottest. Every market's different. The market in Springfield, Missouri, or St. Louis, Missouri, is very different. Yeah, it gets cools off there in like December. Like nobody wants to go look at a home because they're afraid they're gonna, freeze to death or whatever. And it's hard to show homes. These homes don't show as well with snow on the ground or whatever. It's like there's different markets. We don't have that here. Here in the summer, everybody goes on vacation. That's just what happens. Like everyone goes on vacation. So many people. My Facebook feed is just full of like Italy and Greece and all these amazing places people are going. Kind of jealous. But it's just that's the way it is here. And sometimes the whole summer is like that. I mean, June for sure is like that. Sometimes a lot of July is. Maybe we'll start to see some normalcy in August as you start to get closer to kids going back to school within a couple of weeks. But that's a great point too, Michael, is that we have a situation here where kind of that's one of those bad things that's on the table. Like not only do we have inventory sort of spiking a little bit, we have, rates are just barely hanging on a little bit. We have a slower market in general. We have the sentiment has changed, demand has decreased, and we have a lot of people traveling. That's a great point. Thank you, sir. What's up, Alex? What are you seeing as far loans and housing prices? What are we seeing as far as loans and housing prices? Rates are actually great. Loans are in good shape. By the way, Tony, I'm going to reach out to you shortly about your Florida deal. Make sure you're getting a good one there. Rates are in great shape. Much better, like VA rates, FHA rates, mid fours, for good credit. Conforming balances, the higher balance ones, maybe 4.625 or 4.75 for those. Conventionals in the low fives to mid fives. Investment property, quote investment property for a guy today, 5.99%, with 40% down. Conforming balance. It's no points, no fees, and that stuff. And housing prices are coming in a little bit. You're seeing prices just relax a little. Meaning that people if you're listing your house at what it says the Redfin estimate is or what the Zestimate is, you're too high. You got to list it below that. People aren't ready to pay full pop right now unless you have a perfect house for them. And there are some like that. There still are some sellers markets for individual properties out there where those individual properties are getting multiple bids because they're marketed well, they're presented well, they're desirable areas. Those things are still happening. So good question, Alex. Thank you, sir. Yeah, that's a good point. Yeah, that's true. And Michael's making a great point here about traveling. A lot of countries just opened. So there's way more people traveling this summer. Maybe that's why my feed is so filled up. There's way more people traveling this summer because a lot of countries have finally opened after being closed for 2 years. Or a lot of people haven't traveled for multiple years, are getting out there and traveling now, except me and my wife, because we have a 3-year-old and a 1-year-old. And trust issues we have with other people watching them. So we aren't, but a lot of people are. A lot of people are traveling who haven't been able to for the last couple of years, though they've had trips that they had planned that they had to cancel. And now they're finally doing those trips. So there's a lot of people traveling. We'll see what happens in August. It could be a game changer. Okay. Good session, team. Let's see here. All right. Real quick, before I go, you know how to find me. Get you a loan quote. Make sure you're getting a good deal. Tony, I'm gonna reach out to you in a second. Email me, call, text me if you want to get a free loan quote. Whether you're gonna buy or refi, I'm here to help. Make sure you get a great deal and have a great day. You guys have an amazing one, and I'll be back in touch.